Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make you some money. My job is not just to entertain, but to educate you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Their best days are behind them. Those may be the 6 most damaging words to your portfolio, and hardly a day goes by when they don't hinder you from making money. Especially when we're talking about the Magnificent Seven. So many people trade these great stocks rather than owning them. And then you get a day like today where the Dow inched up 49 points, S&P advanced 0.47%, the record high. Tech-heavy NASDAQ gained 0.94%, also to a record high. Days like today remind you just how lucrative it is to simply stick with fantastic stocks. Buy in homework. Stop trading, people. See, there are so many jumpy shareholders because lots of people truly do believe that the best days of all of the Magnificent Seven are behind them. Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. They think they missed the big moves that got these stocks to the heights that they've reached. They are either hanging on now for dear life, clinging, or they exited, failing to get back in, even though they said that they would. It's an odd judgment. After all, when we came up with the term FANG, which stood for, at that point, Meta, Amazon, Netflix, and then Alphabet, a dozen years ago, all I heard was that I was late and the best days were behind them. A dozen years ago. Same thing when I added Apple to the mix with FANG. Late. That's what I was accused of. Let me say this. I believe that if management hasn't changed or there's been a smooth transition, the seven still present incredibly compelling valuations even now, some better than others, but that's okay. And when you look back at how they've done historically, you see that they, for the most part, turned out to be very inexpensive in retrospect. Why do these companies keep exceeding expectations? Why were their best days in front of them, not behind them, for more than a decade of catcalls? I want to generalize for a moment. First, all these companies have tremendous balance sheets with essentially all the money in the world. That allows them to innovate. It allows them to do battle with competitors and win. They can buy whatever businesses they want. Even when the government goes after them, the government tends to fail. Second, they have scale. They can expand with more tentacles anywhere. They're incredibly hard to take on. Third, they reinvent all the time. Facebook starts as a desktop entity with a stock that flops after it goes public, but then it figures out the cell phone for Instagram and for Facebook, and then boom. And, of course, it buys Instagram and it buys WhatsApp. It became a totally different company, taking advantage of its balance sheet and its vision that billions of people want to connect via Instagram. And they were right. Just consider what's going on just at this moment right now. We have the next part of our show is going to be an interview with Apple CEO Tim Cook in Harrodsburg, Kentucky. Now, you may not have heard this, but the Apple Watch has been approved by the FDA to detect hypertension, the silent killer, the leading cause of death. Why? Because it can't be detected. I remember when the watch first came, I went to my cardiologist, and I asked him if the watch could ever be used to flag hypertension. He told me that many are trying, but they most likely couldn't succeed. It would be too difficult, too many false positives, not a lot of accurate reads. Well, you know what that was? It works. It could save millions of lives. If I were a healthcare insurance company, I would make it required wearing for my customers, especially for the big institutions that I give insurance to. Fourth, something good always seems to be in the works when it comes to Mag 7. Last Friday, Elon Musk, what did he do? He bought $1 billion worth of Tesla. I mean, come on, that's incredible, right in the open market. I have never seen a commitment like that, but this is the kind of insider buying you can see when your CEO is the richest man in the world. Now, some of today's strength in tech really has to do with still one more celebration of the data center. There have been lots of questions about whether the backlog is real post that Oracle news, but they seem to have been resolved to the point that it is positive, and demand looks very strong. Microsoft's Azure, Meta's AI, NVIDIA's chips, Tesla's autonomous driving, Google's Gemini, Amazon's web service would all seem to be big beneficiaries of that demand, meaning that they're probably doing so well that you see the input, which is the demand. This weekend, Gemini, the chatbot that many thought would never amount to anything because it's connected to Google, well, it became the most downloaded iPhone app. It passed ChatGPT this weekend, which had been at the charts endlessly. It was breathtaking. The positive news flow never ends here. And yet people are so quick to give up on these stocks, as if their biggest and best days truly are behind them. Take NVIDIA. This morning I get up, I was a little cranky. I don't know why the Eagles won yesterday. I fire up the machine and I read that there's a Chinese entity that says NVIDIA violated an antitrust law. The stock's down 3, then 4, then 5. I get fed up and I take the X. Quote, usual NVIDIA shareholder freak out on suboptimal China news. Join the club and stop panicking, will you? End quote. That was a reference to my own own it, don't trade it policy on the stock of NVIDIA. It doesn't stop, though. The stock just keeps going lower, even as we discovered this inquiry is about something from NVIDIA's acquisition of Mellanox Technologies, a division that gave NVIDIA exposure to high-performance network equipment and not core semiconductor business. That was 5 years ago, and the Chinese okayed it, and yet it caused pandemonium. But what happens with stocks like this? You know, by 11:50, the stock's in the black. You would have caught 6 points if you bought at the low. More important, though, is that NVIDIA could bounce right back, even if the stock only closed slightly in the red. That's a sign, once again, that so many are skittish. NVIDIA's shareholder base is full of people who probably shouldn't own the stock in the first place, because the moment they hear about a Chinese antitrust investigation, they think they've overstayed their welcome and they sell. That's always how it has been with NVIDIA. Always. People who don't know what the company does figure there's no future because they don't even know the past. Look, I know the Magnificent Seven have had their setbacks. Alphabet looked like it was going to be a goner, severely punished for anti-competitive behavior not that long ago. The judge in the remedy portion of the trial, after Alphabet had already been found guilty of being a monopolist, could have easily gutted the company, which is why its stock fell as low as 140 in April. But it didn't happen. If anything, it was real clear that Google's remedy was to keep doing what it was doing for the most part. Now the stock's at $251 and change after soaring another 4.5% today. I made the mistake of selling the stock for my Travel Trust. I play with an open hand. I believe that the government would come down on them with a hobnail boots. I did think Alphabet's best days were behind them because of what was going on in the federal court. I was totally wrong. Got that? I was wrong. No company is completely in control of its own destiny, but these 7, they come as close as anyone ever has, which is why I believe that their best days are still in front of them. Yes, if you don't own them already, maybe you missed a huge amount of performance. I'm not going to deny that, but I'm not going to say that you're too late. I think there's too much good happening to consign these stocks to the dustbin of history. They just don't have any quit in them. The bottom line, the Magnificent Seven are heroes, and I'm not going to tell you to sell heroes unless something changes that makes them feel a lot less heroic. That hasn't happened, though. They're still got great management. They still are overflowing with cash, and their scale is so enormous that no one can stand against them. What's not to like? Cody in Illinois. Cody.
Booyah, Jim. How's it going?
I'm doing fine, Cody. How about you?
Doing great. I love watching your show with my girlfriend's dad, and excited to be talking with you.
Sensational. I'm glad you called in. How can I help?
I'm wondering what's going on with Toast, Jim.
You know, look, I'm glad you asked about this. I actually thought the quarter was excellent. I know there are a lot of doubters. I think that's wrong. But the restaurant stocks have been very weak, and that's why I think that Toast has been very weak. I'm advocating patience because it's still a great stock, and it's still up a lot for the last for this year. How about we go to Nathan in Colorado? Nathan.
Hey, buddy. First-time caller, long-time listener.
Excellent. How can I help? What's up?
I'm calling about a stock I've been holding for about 3 years, trading at prices 9 years ago, down $100 in the last year, plays a dividend over 6%, United Parcel Service.
I am worried about United Parcel. I'll tell you why. It's down 33% for the year. Because when I see a yield of 7.8%, it worries me because there's not a lot of yields in the S&P that are that high. The highest yielders tend to be trouble. They do not tend to be reasons to buy. Maybe for Verizon when it was, or an AT&T because they're utilities. But this is of grave consternation to me on UPS. I wish I could be more positive, but that's how I feel. John in California. John.
Howdy, Jim. John from Lompoc. Listener since 98. Thanks for the education.
Oh, wow.
Group and the rate cut.
For which stock?
Citigroup.
Citigroup? Yeah. Oh, I like Citi. Now, Citi's up a huge amount, But I think Citi is still an inexpensive stock. It's got still a lower multiple than others. I think it can go higher. Yields 2.4%. And what can I say? Jane Fraser's doing an admirable job there. Anyway, look, there's just no quit in the Magnificent Seven. And I don't think you're too late to get into these names. There's too much good happening with each company. On Mad Money tonight, Chewy plummeted after earnings before climbing back after catching a couple of upgrades. I'm sharing where I think the story stands after these conflicting headlines. Then I'm hearing how a partnership with NVIDIA is ushering in a new AI era for Jacobs Solutions, letter J, with the company's top brass. But first, last week, I visited Corning's plant in Harrodsburg, Kentucky, where big tech meets small town America. But the story doesn't stop at the factory gates.
Welcome, everybody, to Harrodsburg. You are standing on one of the oldest streets in west of the Alleghenies.
Jim Cramer and Tim Cook take a stroll down Main Street, USA. Next. Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. Hashtag #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Last Friday, I got a chance to speak with Tim Cook, the CEO of Apple, and Wendell Weeks, the chairman and CEO of Corning, at Corning's facility in Harrodsburg, Kentucky, where they make the cover glass for your iPhone. While I was down there, we spent a lot more time with Tim Cook, getting into everything that's been going on with Apple. Take a look. Well, Tim, we're in downtown Harrodsburg. You talked about the ripple effect. Is this it?
This is it. It really makes my heart sing to see a town that is doing so well, that's thriving off of Corning, and our relationship with Corning is at the root of that. And so it feels fantastic.
Now, there are other towns, of course, that didn't get blessed by two companies that care as much as you and Corning do. The atmosphere is very different, isn't it?
Well, we can't be everywhere. I wish we could. But we are putting $600 billion to work in the next 4 years. And so it is an extraordinary commitment. And there's 79 factories across the U.S. that will benefit from this.
But don't you think you'd have to put up 10 times that if you're just to be able to say, I mean, look, you got to put the money to work. You promised the president you're going to put it to work.
Yes, we are putting it to work. And
but $2.5 billion is a drop in the bucket of what you have to do.
2.5 is just one of those 79.
Okay.
And so one of the 79. And so it's a great start and a very important one, because the glass is something you interface with all the time, right, on your phone. And we couldn't be prouder of the relationship that we built up over what is now since the first iPhone in 2007.
Now, when you speak about the ripple effect, it's not just what it does with towns. I imagine that there will be companies, foreign companies, that will say, okay, I now have to put a factory there because Apple's there and they're building a supply chain and I can be part of it.
That's right. That's the ripple effect. If we come, there will be more companies coming. It's a domino effect kind of thing.
It's better than anything the government can do, isn't it? I mean,
I think with the
enterprise versus government.
I think the government has a role in terms of the regulation kind of role, and setting the leadership, which the president has clearly done. He's really stated his objective to get more and more manufacturing into the United States. And so I think there's a role for each party.
I want to just say that the one thing that seems to be left out, the president wants to be able to have everything built here, but you have to have great education. A town like this is going to have to up its game, but you're not responsible for that.
Well, what we can do is bring the Manufacturing Academy in Detroit to small and medium-sized businesses. Corning obviously has enough stature to train their own employees. but we can help that significantly with small and medium business. And we can help with community colleges and these sort of things in getting some of our curriculum out into those schools. And so we do have a role.
Okay.
We do run a university as well, but we do that for internal to Apple only.
Tim, you talk to shareholders all the time, part of your job. Do any
Sure.
of them say, you know what, look, $500 billion, I mean, I wish you would just buy back stock with the $500 billion. Why are you wasting shareholder money?
You know, I think most of our shareholders believe that we're in the best position to make these type of decisions. And so I have to honestly say, I haven't gotten a single complaint about the $600 billion.
When it went from 500 to 600?
Not one. I have not
Really?
seen one.
Not one?
Not one.
That's kind of remarkable.
Yes, it is.
I would think there are people who could be enraged and say, you know what? I think he's just doing it so he can sell in China or to appease the president.
I'm sure there's somebody out there like that, but they haven't contacted me.
I'm astonished.
Yes.
I really am. I mean, maybe I'm too cynical on Wall Street. I figured that there would be some people who would say, listen, you could give us a better dividend. Instead, you're helping to Harrisburg.
Yeah, I think most people look at it and say, it's great that you're investing in America. And so I think they look at it through that lens and depend on us making decisions in their best interest for the shareholders.
Now, are you in contact with people in China who say, look, we want those jobs too. What do we have to do? Or has things gotten so adversarial, China, India, that the discussions can't occur anymore?
No, we have good relationships in both of those countries and have a very open line of communication and also bring jobs to those countries.
See, as I think there's a lot of people who think that we're in some sort of vicious Cold War. I know that there are obviously issues because we do have, you have Taiwan that has to be protected. You have a government that at times has been jingoistic there, and we got jingoistic here. But you're able to navigate that kind of thing.
I think, my view has always been is that engagement is so important in all of these countries around the world and with all the governments of the world. And so that's what we try to do is bring the best of ourselves to those countries. And I have to say, I have great relationships in many countries around the world and want to keep that up. I think it's important.
In your interactions with the president, you apprise him of these kinds of events and what's going on?
Oh, of course. We had the event in the Oval just a few weeks ago, right? And so he's well versed on what's going on in Harrisburg. And
that must mean to some degree that I know that it's no quid pro quo with the president. It's not like, listen, I'll take the 25% tariff off. But obviously, the more you do here, the less likely there will be a 15% take of what he's doing, of what you're doing in China. I think it'll be heavily considered. Okay. Yeah. Right. Well, you're doing what he wants, but I think that we're doing what he wants, which is to bring more manufacturing into the U.S. and more investment. But is it metaphorical to say that I want the iPhone built here? Meaning, in other words, if you spend $100 billion here versus making it here and you'd only make $20 billion, I mean, obviously the commitment is huge enough. The commitment is huge. And it will definitely be felt in many communities across the country. Who's monitoring it internally for you? Kevin, the CFO? Of course, Kevin is all over it, and I'm personally monitoring it to make sure that we're living up to our commitments. Are there towns that don't know it yet that are about to be blessed with a lot of business? There are, of course, because these things take some amount of time and so there will be some surprises in there, I would think. Now, why was in 2017 it was $1 billion commitment, and a lot of people were shocked at $1 billion? I mean, $600 billion is a lot more than you announced when you announced the plan on our show in May of 2017. I mean, it's quantum. It's quantum. It's quantum, and we're so proud of it. We're proud to be making a difference in people's lives.
Coming up, Cramer's chewing on Chewy's latest results and reveals if the stock has more bark than bite. Next.
This has been a very good year for stocks, but the market's still unpredictable. Take a look at what happened to Chewy last week. Last Wednesday morning, the online pet food company reported a solid quarter, better than expected guidance, yet the stock got obliterated in response. Then the very next day, Chewy caught 2 upgrades. Today, the stock came roaring back up almost 7%, but it's still down versus where it was trading before the quarter. It is enough to make your head spin. What on earth happened this quarter that crushed the stock, but simultaneously made 2 analysts feel confident enough to upgrade it? Okay, at first glance, this was a very good quarter. Chewy posted accelerating revenue growth, expanding gross margins, and inline earnings. While they mostly left their full-year forecast unchanged, other than narrowing and raising their revenue outlook, Chewy's guidance for the current quarter was pretty strong. It didn't hurt that the company bought back $125 million worth of stock during the quarter. Still, the stock plummeted more than 16%, 1/6 last Wednesday. So what kind of landmine was hiding in this quarter that could blow it up like that? All right, now look through the results. And you can point to the fact that Chewy had higher than expected sales, general and administrative expenses, and those expenses actually grew faster than revenue, largely because the company's ramping up on a new fulfillment center in Houston. I think the new fulfillment center is an unmitigated positive. It's full of automation that will ultimately make Chewy more profitable. But apparently it takes about 6 months for these facilities to get them rolling. Wall Street did not like learning that. Phew. But I don't think the higher SG&A expenses were the real problem. In the end, this was about expectations. Most of Chewy's numbers came in higher than the consensus analyst estimates, but they didn't come in higher than the so-called whisper number, which is what the really bullish hedge funds were looking for. They call it a whisper number. To put the final nail in the coffin, management said that the second quarter will mark the high point of the year for gross margins. They plan to make growth investments in the back half of the year, and those investments are expensive. Still, does that justify the 16% beat down in the stock? I don't think so. And neither did some of the analysts. Deutsche Bank and Seaport both upgraded it last Thursday because the stock suddenly got too cheap and the story's too good to ignore, which is one reason why it came roaring back today. What makes me say that? First, when you dig deeper, there was genuinely a lot to like about the quarter beyond the headline numbers. Chewy put up 8.6% revenue growth in an industry that's only been growing in the low to mid-single digits. I mean, these guys are taking market share. Much of that strength came from something called AutoShip, Chewy's subscription service that provides recurring scheduled deliveries for anything from pet food to medications to treats. In fact, 83% of the company's business comes from AutoShip orders last quarter. That's a good subscription business. As for the expensive growth investments that scare people, here's how the analyst at Deutsche Bank put it, and I'm going to quote, "These investments serve to strengthen Chewy's long-term earnings power," end quote. While the fulfillment center in Houston might be taking longer than expected to ramp up, this is part of management's plan to increasingly automate their distribution hubs. With the help of this Houston facility, they expect that nearly 50% of their volumes will be automated a year from now. That's ultimately much cheaper than doing everything with human beings. The other firm that upgraded the stock, Seaport, has some really bullish things to say about the Chewy Plus investments. Chewy Plus being their annual membership plan with free delivery like Amazon Prime. Here's how Seaport put it, quote, "These investments are offensive, you know what I mean, and should enable Chewy to further gain market share," end quote. Now, again, this makes sense to me. On the conference call last quarter, management likened the subscription service to Amazon Prime or even a Costco membership. You know how much I like that? The value proposition here is just that good. Aside from the $49 annual subscription fee, Chewy Plus members tend to spend a lot more time on average than non-members using Chewy. So they naturally want to sign up as many people as possible. I really like this. These guys launched Chewy Plus in the summer of last year, and as of July, it was already making up 3% of their monthly sales. Management sees that number slowly creeping higher, and I believe them. What about the higher expenses that freaked everybody out and pummeled the stock? Very simple. Chewy's giving you a free trial period of 30 days to try Chewy Plus. In the short term, that's going to put pressure on the margins, of course. But longer term, I think it's a great way to lure people in. What else? Both upgrades last week called out Chewy's recent launch of their own private label dog food brand, Get Real. This is all minimally processed food, with each recipe being made with 10 or fewer ingredients. Now, I am not a dog connoisseur. But I am a huge fan of retailers that get into the private label business, and I like my 2 dogs, although one of them is just, well, never mind. Selling your own knockoff merchandise carries much higher margins than selling someone else's brands. And they don't know the difference. That's the key thing. The dogs will eat it. This is part of Chewy's push to expand their presence in the quickly growing fresh and frozen pet food market. The product's only been out for a few weeks, but management says customer reception has been strong. I wonder how they measure customer satisfaction for dog food. Still, I have no doubt that these pets are eating healthier than a lot of people I know. And one time we had another brand that was in the refrigerator, and my stepson thought it was bologna. Cut it up a little. Phew. It doesn't taste like bologna. Trust me. And make no mistake about it, customers are happy to pay a premium for the stuff. For the full meal option, management expects the customer to shell $2,500 annually per pet. That's the power of the humanization of pet thesis. That's still true, that people are increasingly treating their cats and dogs like members of the family. $2,500 per year, that works out to almost $7 a day. Not a lot to spend on food, but quite a bit to spend on dog food. So here's the bottom line. I think it's crazy that Chewy sold off over 16% in response to a large and good quarter. I think the two analysts were right to upgrade the stock last Thursday, and the buyers were right to step in today. So even though Wall Street's not happy about all the Chewy spend on growth initiatives, call me on board. This will make Chewy a better investment long term. You have my blessing to buy it, even after the rally it just had today. Now we're going to go to Buddy in Rhode Island. Buddy.
Hi, Jim. Great talking with you. Love how you teach me and taught me actually to buy stock in increments as it goes down, as opposed to buying everything at one time.
Yes.
So I really appreciate all your knowledge. I'm a club member, and
thank you.
I've been a club member for over a year. I'm curious. I've been watching ELF. I know that you've been hot on ELF last year. I know that it reached close to 200. I know that that's not a number that we should be thinking about now, but it's risen so much lately, but I'm worried about the China scare. Am I too late to get into that?
I would not worry about the China scare because it's what I call baked into the stock. What I would worry about is the parabolic move we have today. I mean, ELF is up 9. I think we have to wait till it comes down. I'm thrilled you're in the club, but I know if I were in the club right now and we owned ELF, I would say trim, don't buy. That's just a parabolic move, and that signals that it's up too much. All right, I think Chewy's sell-off in response to largely solid quarter is crazy, okay? And I think you're getting a really good chance to start a position in Chewy right here. Much more Mad Money. I include my exclusive with Jacob Solutions. Jensen Wong has been telling us for years about the power of digital twins, and now Jacob Solutions is putting that technology to work. I'm hearing more about it from the CEO. Then the president wants to end quarterly conference calls, but where do I come down on this controversial stance? Man, I got to tell you, I got to give you my take. I can't wait. And all your calls rapid fire in tonight's edition of the Lightning Round, so stay with Cramer. One thing I love about the AI data center boom is that it just keeps creating winners in unexpected places. Take Jacob Solutions. It's the engineering construction firm that went through a complicated merger breakup deal last year that was very successful, but is now cleaning up thanks in large part to its data center exposure, which has become a major growth driver for the company. Don't take it from me, though. Let's check in with Bob Brigada. He's the chairman and CEO of Jacob Solutions. Learn more, Mr. Brigada. Welcome back to Mad Money.
Jim, always great to be here. Thank you.
Okay, so Bob, it turns out that what you're doing is exactly what I wanted our viewers to hear about. First, let's just talk about data center, and then let's talk about digital twin. Okay. But this data center business falling in your lap, you're one of the few companies that can build them.
We are. So, Jim, we've been in that space since back in 2007. So in the advent of data storage and the requirement for a data center, we started doing the design around what we used to call the white space, the server room, the gray space, the utility area. But then they were conventional data centers. So we'd hook them into the grid, hook them into the municipal water supply, and that would be it. Today, it's a big difference. And we're now into the AI data center, which is really a complex facility right down our wheelhouse.
But I was going to say, not only is it complex, and we've been to one of them, that I have a belief that if you haven't had the experience, it's too risky for the company to hire you.
It is tough. There's a bit of a moat that's around that as well. And the fact that we've been in complex facilities, whether it be in the semiconductor world, life sciences, that's kind of in our DNA. So the history in the data centers coupled with that complex facility experience.
And I want people to know at home that when we saw you last, you were talking about a breakup. And I was worried because there's a lot of pressure and a lot of breakups, but yours came through terrifically.
It really did. And the new company, Amentum, is doing well. But we've been separated now since September a year ago.
Right.
And out of our retained stake back in March, And they've been doing well. We've been doing well and continue to grow.
Sensational. Now, I happen to be reading I guess you call it a press release from NVIDIA. I always like to see, I love it when I see Madison Wong writing the press release. Yes, that is Jensen's daughter. But it's about the idea of optimizing the data center using the digital twin. Now, we've used that term, and Jensen has shown it, but I think that since you're the actual builder, you can tell us the value of the digital twin.
Yeah, absolutely. It takes what used to be in disparate areas. So you had the compute load, what the power requirement would need to be, and then the facility to support the entirety of the system. Today, it's gotten pretty complicated. So as the compute load is innovating at a very rapid pace, what NVIDIA has asked us to do is be the design integrator and look at that from a systematic perspective. So we did the reference design for a gigawatt plus facility, and then we did a digital twin. So now you can simulate in the virtual space what's happening with compute load, the effect that it has on the utility requirements, and then longer term, how do you operate something like that?
Okay, so I think people at home will say, well, what does it save? I mean, so what? A digital twin, I mean, are these buildings so hard to do that maybe there's construction changes? And I think you have to tell us why a digital twin can save money for the customer.
You're working out in the simulated model, in the virtual space, the nuances of what's happening with rack power, the need for liquid cooling, potentially the need for liquid cooling and air cooling, and then where's the power coming from, as well as the water requirements for all that cooling. So this is now taking what used to be a data center, still is,
right,
and turning it into an AI factory, and then the support infrastructure that's needed for that, all within the virtual space. Because the innovation that NVIDIA is doing right now on the chip design, it's going at a very, as you know, Jim, at a very rapid pace.
All right, so here's something that I am trying to figure out. How do they hook them up to the grid? If they're such big, if they're just these monsters that want all the electricity, do you do that? And how do you be sure that there's enough power?
So we will design the requirements for the power needs within the data center. And then we will look at, there's a couple of different options. Sometimes in some locations, West Texas, Montana, the grid can handle it. There's other places where it can't, so you go into alternate sources of power behind the meter.
Like nuclear power?
Like nuclear power, like LNG, like on-premise LNG, combined cycle power. In
and this is something you like when you go down, do you say, oh boy, it looks like we have to tap into some grid, part of the grid that no one ever thought of, or we have to route it away from everybody else to us, and maybe there's an equity issue. Maybe some of the other people get mad at you who are customers.
They could. They could. I think what's really, really important is that determination of, can the grid handle it?
Right.
Or do you have what they call on-premise power? And then during peak loads, depending on the source, the use of batteries and battery storage.
That's what I hear, that's really taken over.
It is.
Wow.
So it's the complexity that I was talking about earlier, where we're right in the middle of all of that.
But the complexity is not a problem for you. For instance, in the GLP-1 drugs, those are complex. I'm sure the buildings are complex, but that's something that you're now used to.
We were right there with those GLP-1 manufacturers.
Yes, you were.
From the beginning, when the formulation was at bench scale, going to commercial scale, to determine what the facility requirements would need to be.
Well, I mean, I just think that maybe the next generation of what they're working on could be yours too.
It could be a tableting form.
Yes.
It could be, and that could be really, really
we think
exciting.
a tablet form could be big, and we know that therefore you don't have to refrigerate it, and it could be one of those things where people don't like to give themselves needles. I would like to think that they are ready if they do pass the test.
Absolutely, and Jim, there's another dynamic that's happening in that space. It's other companies besides the two we've always talked about that are now coming in with their own molecule. So that ecosystem of producers is now expanding.
Well, I understand that there's plenty of room for everybody. That's always, even David Ricks from Eli Lilly would tell us that. Well, I want to thank Bob Brigada. He's the chairman and CEO of Jacobs Solutions, which has been a total winning stock. And you just heard, they really understand how to build these factories, which are so difficult to do. Mad Money's back after the break.
Coming up, lightning doesn't just strike twice in Cramerica.
Booyah, Jimmy Chill.
Booyah, booyah, booyah.
Thanks for taking my call.
It strikes every day. Cramer is back in a flash with your questions. Next.
It is time. We're talking to the lightning round because everybody that's for after. We're only 10 minutes. Talking about myself, just better the call. So my step bears the graphics of the fire. You plan this out. And then the lightning round is over. Are you ready? Ski deck. Now, lightning round Clippers might start with Nick in New Jersey. Nick.
Booyah, Jim. I'm calling about QXO Inc., ticker QXO.
All right, this is Brad Jacobs' company. Brad Jacobs is money. I'm not going to go against him. I'm going to go with him. You should buy the stock. Let's go with David in Connecticut. David.
Hey, Jim. Thanks for having me on the show. I
Thank
just
you.
wanted to, say I appreciate it. And also ask you about Bloom Energy, because I know that you were less than sanguine about the stock.
Well, but here's the issue. As I went public with Oklo in the 30s, once you have an energy stock, small SMR, here's the deal. We're so short energy that we need every single one of them, including Bloom. So I understand why it's going up. It's not my cup of tea, but I understand why it's going up. Let's go to Susan in California. Susan.
Hey, Jim, always happy to get your wonderful advice. I am a very long-time listener.
Excellent.
So I'm invested in gold for the first time. Its RSI is about 47. It's running slightly ahead of GLD on several other gold stakes in the year to date. And I have learned that when interest rates go down, kind of slow in learning things, gold rises. So it makes it more attractive than bonds.
All right.
What do you see the near-term and long-term investment in Newmont Corporation? And
Look, I think Newmont is excellent. I do prefer Agnico Eagle, but Newmont is absolutely fine. Those are my two favorite golds. Let's go to Jeff in New York. Jeff.
Hey, Jim, how you doing?
I'm doing well. Jeff, how are you?
Good. What do you think of Lam Research?
Someone downgraded Lam Research the other day, and I said, are you out of your mind? That's the chief intellectual property of semiconductor capital equipment. I think it is still a buy, even though it just had this parabolic move up 65%. Do not sell it. Be a buyer. Let's go to Chris in California. Chris.
Oh, yeah, Jim. Thanks for taking my call.
Of course.
Okay. I got my long-term stocks that I don't plan on selling for a long time, like NVIDIA and Boeing and Apple and Disney.
Excellent.
But
Love those.
Also, there's stocks that, you trade every now and again, 10 seconds, a minute, a week. One of them that I've been trading every day for the last week, but I've noticed it's been getting consistently higher and higher, and I really consider making this a long-term stock. What do you think of LDI, Loan Depot?
I don't understand how that stock could be up this much. I mean, I know about the Fed, obviously everyone does, but it's losing money. I'm not there for that one. I'm just not there for that. I can't understand it. Let's go to Bob in South Carolina. Bob.
Evening, Jim. Big booyah.
Evening. Booyah to you.
My question is about Centrus Energies.
Okay, now this is a good example, like Oklo, okay? I am a big believer in nuclear power. This is a company that supplies low enriched uranium, and that means it's going higher. And now, do I want it? All I can tell you is I'm not fighting it, okay? I've fought all these speculative stocks. This is really not even that speculative. It's got a lot of money. I think it's a good stock. Let's go to Gus in Utah. Gus.
Booyah, Jim. Thank you for getting my call.
Right back at you.
AB, Alliance Bernstein.
Okay, now that is a company that historically has had a very big yield and is actually not a dangerous stock. I'm going to say I think you're okay, Alliance Bernstein. Let's go to Chris in Florida. Chris.
Cramer, how we doing?
I'm doing all right. How are you?
Good. Calling from Chip and Bug Wealth headquarters at Florida State University. Go Noles, come on.
Go Noles, man. I'm right there. 1819 Pensacola. That's where I live, right near Jim and Mills. Good barbecue.
Let's go. Gain Street. I got a IESC ticker symbol for you. What do you think?
ISC. I know that electrical contractor that, again, is going higher because it is data center. Do you see the pattern, everybody? And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, good quarter, bad quarter, or no quarter at all. What Trump's push to scrap quarterly reports could mean for the market. next.
Jim Cramer, the diehard of the dollar.
Hey, Jimmy, love the show. My 5-year-old grandson loves to watch your show.
I have to thank you for making us money when it's there to be made.
Our world is a better place with you in it.
The president weighs in on Truth Social about pretty much every issue. He posted earlier today that he didn't like the new NFL kickoff rule. He thinks it encourages sissy football, which is bad for America. I guess that rises to the occasion of presidential attention. President Nixon tried to insert an actual play years ago to the Washington team, and some believe a variation of it was used and resulted in lost yardage. So it's not the first time a president has tried to involve himself in the NFL. Right after his NFL statement, though, Trump did post an incredibly provocative suggestion for the business world. Rather than making public companies report every quarter, he wants to let them report every 6 months, like they do basically in the European Union. In fact, he points out that China is a positive example because he has their turn thinking in terms of 50 to 100 years. What's right? As someone who pores over every conference call and lives for the quarterly data, I disagree with the president. I think the more information, the better. You can't really make good decisions, certainly about money, without that quarterly data. But as someone who founded a public company, I can tell you that quarterly reporting is a nightmare. Tying up time and causing you to focus on the short term so you don't disappoint Wall Street. The fees to auditors are prohibitive. The lack of people in finance who can drop everything and get things done is daunting. In other words, it's a huge pain in the neck. From the perspective of management, the president is spot on. Warren Buffett and J.P. Morgan, Jamie Dimon actually weighed in on this issue a few years ago, and they're with Trump. These two titans believe that companies frequently hold back on technology spending, hiring, and research and development to meet quarterly earnings forecasts that may be affected by factors outside the company's control, such as commodity price fluctuations, stock market volatility, even the weather. Good point. On the other hand, one of my idols, the late, great Andy Grove, the person who built Intel into the most dominant semiconductor company on earth in the 1990s, was a big believer in the quarterly report. He wrote a phenomenal business book. I mean, it holds up really well. You get it on Amazon. It's called Only the Paranoid Survive, where he was downright contemptuous of the idea that it's too hard to report every 3 months. In Grove's view, it's the only way to enforce discipline and accountability. He believed that executives should live in fear of their investors because that produces better results. I gotta tell you, I agree with him. I've always thought that Grove's view should prevail simply because shareholders deserve as much information as they can get. A quarterly report is not too much to ask. That said, there are two legitimate sides to this issue. As the process exists, it's hard for companies, especially smaller companies, to handle their quarterly reports. It might be easier for them to report every half. If we could get away from the endless forecasting straitjacket that occurs each quarter, it could make the process less onerous. Companies shouldn't have to give you so many benchmarks on what could happen because we don't have the kind of crystal ball. A 6-month reporting period with no forecast would make the lives of the CEOs much easier and could possibly spur longer-term, better thinking. But in the end, if you're an investor, you want as much information as possible. Anything that allows companies to give you less data is bad for your portfolio. So even though it's a headache for companies to report every 3 months, I think it is much better than the alternatives. I'd like to say, as always, bull market summer. Promise fit just for you right here, Mad Money. I'm Jim Cramer. I'll see you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.